We start today's market talk. You see, you buy when there is fear on the street, and money making is not a formula. So, if you see the market construct today, who are the sellers? FIs, Ps, promoters, and they are selling with choice. They are selling when the market goes up. They are able to time the market. And who is the buyer? Retail. And they are forced buyers. Har mahine they are putting money. So there is no choice for them, which is not a healthy way to put money in the market. And actually, if you see, domestic selling by promoters and IPOs has been much more than FI selling. And I wanted to highlight that. So it is incorrect to say that FIs are the ones who are exiting and that's why markets are not moving. These guys are seeing it and like I'll just give an example of this month of December. Roughly around 30,000 crore money is coming in SIP. That's a fixed amount of money, and there might be other EPFO money and extra which is coming. Now, this month, there have been 35,000 crore of IPOs which have gone out, 15,000 crores of right issue, and I'm not counting the Adani right issue, 2,000 crore of QIP, and 5,000 crore of block deal. So, roughly 50,000 plus crore have moved out also. And total fundraising in calendar year 25 has been 3.8 lakh crore. So 3 lakh crore of SIP money comes in into equities in a year, and so people have found it and now they are taking the money out. And you wonder why your portfolio is not growing anymore. It is because these guys are just become too greedy and just taking out the money. And you see, the other point is the mutual funds are a relative return business. Means they are not looking at absolute returns. These funds have to outperform a benchmark only. So if they are able to outperform the benchmark, their performance is good. Nobody is looking at absolute returns, etc. And the other point is fund AUMs are growing faster than earnings. So it is automatically resulting in high valuation because there is more money. Earnings are not going at that pace. And you see, the other point you must understand, for every buyer, there is a seller also. Na? So somebody is selling. And you can't buy expensive and get away for long unless the growth keeps up. So if you have bought something may I say, August, you wouldn't have got your price even today in most of the cases. So the reason is because we have got excess money which is coming in. It should ideally be made to go to global markets, but that is not permitted by RBI. So there is a concentration of money into Indian equities, which is making them expensive irrespective of the performance. Hence, we are seeing 1 year of flat to negative returns since October 24. Why I'm saying money making is not a formula? Because what is being sold is a SIP as a formula. And it is not even systematic in the present scenario. It is like a monthly investment plan. So it is not systematic. Systematic means when you buy when there is a dip. That is systematic. So it is not a formula. You can't afford to make money when everybody is in the same game. So you buy when there is a fear on the street, and at present, you are the cash flow for all the people who are looking to exit. Okay. So market construct right now with the US economy expanding at its fastest rate in 2 years at 4.3% growth rate, that is the real GDP growth. The nominal GDP growth is around 6.5. So at 6.5, 31 trillion economy is pretty good. So they are really doing well. Now, what this means for Indian markets, it has tilted the balance in favor of American assets, dimming hopes of a quick comeback by foreign investors into Indian stocks and bonds. Uh, Global capital, in addition, is nowadays chasing gold and silver. hunting for next wave of growth via AI and new technologies. And we have nothing in these issues. Nothing in AI, nothing in new technologies. Better than expected GDP numbers make it harder for Fed now to rush into rate cuts. Now, US Treasury yields have stayed above 4% even after the GDP release data. For India and other emerging markets, liquidity is unlikely to be plentiful anytime soon. So, the thought process was that if the Fed cuts rate, there is abundant liquidity, it will flow into emerging markets. So, that is again a doubtful issue. And why should somebody invest outside if your own markets are doing so well? The other problem is rupee remains tentative. It is another reason for global funds to stay cautious. And there was so much of talk about AI trade cracking and selling off overvaluation, but it hasn't cracked. So that again, that money is not moving out. FIs have been selling in equities and bonds despite inclusion in JP Morgan bond index, and that is the reason why the rupee has been going down. As January begins now, this year is over. As January begins now, no FI is waiting to invest in India. So for that, for them to be changing their focus towards India, Indian earnings need to improve drastically. We have to improve our earnings. Rupee has to be less volatile, and valuations have to be more reasonable. Otherwise, it'll be very difficult to change the narrative. Now, the other problem is Indian stock market will see more money being sunk into the consumer tech industry. Now, this is another problem. We are all quick commerce players are now raising cash. Swiggy recently did a QIP. Zepto's IPO is in 2026 of roughly 11,000 crore. And most of this money will be spent to acquire and retain customers and push sales. That means it will be burnt. So there will be no real asset created or earnings will be created, and they will remain loss making. So what is the construct is, you see, people have put into Swiggy QIP at 400 bucks, your mutual fund money. Now what happens is, so your mutual fund holds it, he holds it for 6 months, and then the stock starts going down. It goes down to 350 or something. So how would your portfolio do well? I don't understand this way of working. And same thing is happening with IPOs also. For retail investors, it always pay to reassess investing goals and ensure a diversified asset allocation that fits them. So 2025 has shown enough examples of how it is difficult to pin down winning asset classes at start of the year. Nobody knew at the beginning of 2025 that silver and gold will outperform. So it's very difficult, or large caps will outperform mid caps and small caps. So earlier last year, the year was of small caps. Now this is the year of mid caps. Oh, sorry, large caps. Now, nobody knows what will be the construct, how things will move in the next year. So you have to have a clear asset allocation goals and thought process and stick with it. So prices will keep moving up and down. Now, we discussed about USD. So, RBI's intervention led to the INR strengthening, but again it has started going. It tested 90 level, so it remains a issue. Now, this is what is silver. This is 3 months chart of silver. So, if you see a beautiful head and shoulder, right? Beautiful head and shoulder, and with large volumes, and it has broken out. It has reached that 80 odd level, and this is the paper market trade, not the physical market trade. I think on Monday we will see it heading to 85 or above that. So that is how it is. Somebody's volume is on, please switch it off. Now coming to FI's DI's data. So if you see on 26th December, FIs added shorts in index futures, sold calls, and bought puts. So they are overall bearish. Pros, so if you see professionals, They again added shorts to index futures, sold calls, bought puts. So they are also bearish. Now clients, they added longs, bought calls, and sold puts. So they are bullish. So it is in between. Nothing has changed, and I think it will remain like this till expiry, and after that we will see what happens. So, and if you see the FIDI data, it's very simple, right? See, 3 days they were bearish, markets came down. Before that, 3 days they were bullish in terms of index options. The markets were in the green. So it is all related to their index options positioning as to how the markets are moving. Now, coming to the US GDP growth was higher than estimates, but there was strong decoupling between economic growth and employment. Hence the 10-year and dollar index declined as the inflation is cooling. Also, there is expectations of two rate cuts will reduce the uh, carrying advantage of our dollar, etc. So, market participants, instead of seeing the good GDP growth, are looking at rising unemployment and weak consumer confidence. So, what is happening is that US bond yields came down last week. Similarly, with the dollar index also came down. It went below 98, so it is in this zone right now. Now, gold, uh, safe haven flows. Gold is moving. Other central banks like Bank of Japan are raising rates, so dollar becomes less attractive, and the money starts moving into all these precious metals, and is a big catalyst for these metals. Central banks buying in gold, buying as a hedge against debasement of fiat currencies, is one of the main reasons why the gold is in a strong rally. It has been rallying throughout. Now, silver is a different game altogether. It has gone up 18% last week. So the last move is just vertical. So it can go to any level now because there is an industrial squeeze and supply deficit, etc. The other thing which is moving, actually, copper future prices were not moving that much as the stocks were moving. There are some incidents of some mines in Indonesia getting closed, Chile and Peru production is getting disrupted, etc., and some 50% tariffs on certain copper imports were put by US. So there were some issues, but it's not that big a issue that the way our stocks were rallying. Now, Bitcoin was stable, nothing much happened. Brent crude also not moving, around 60 odd now. So S&P 500 made a fresh high. So they are doing well, and AI trade is back. Nasdaq again was higher, and Dow also made a fresh or is moving up, a strong 1.2% in a in a in a slow trading session. Still, it was up. Now coming to India VIX made a lowest close. Now, I wanted to highlight this. Such low volatility phases precede a sharp directional move. So, what generally happens is that you take a position now, and then the VIX moves up. From here, the VIX will can only move up and move up sharply. Most probably, the VIX will move up with the earning season, etc. And then what happens is, what positions you have taken, you will not be able to make money because the VIX has moved up. So the premiums will rise. So it is good for option buyers, but not good for option sellers. Now coming to Nifty, cautious but steady market tone. Weekly chart, it made a gravestone doji candle. So that means what? Hesitation at higher levels, not sure, but it is at all-time high. So any push can take it higher. Uh, and go beyond to 26,500 odd zone. Resistance is at 26,200, 26,250, and support is at this 25,800 and 25,850. This is the clear the daily charts will give. So it is consolidating around this 26,000 zone, up and down. So it tested this 26,000. So right now the immediate support is 26,000. Below that, the 50 EMA has been giving support. So that's why I said 800 to 850 should be a decent support. Next 50 was positive, but it is at support now. It has not moved up much. So it is that broader market is not performing. Nifty Bank, uh, small bodied red candle, it is coming down. So it is not really performing. On the daily chart, sorry, just on the daily chart, it gave a close below the 20 EMA, so it should be a concern. Uh, so the support is at around 58,700, 58,600 zone, and resistance at around 59,400, 59,500. PSU banks continue to remain above the previous high, but the rally has halted now. So let's see what happens. IT had made a red candle after the last announcement. Now, uh, I think it has moved up too much because earnings will not be that great. And I'll show you the Infosys last quarter's earning. The problem is our IT services firms are not able to see the future, and it's a case of classic disruption. They have not moved into what the world is doing. And we were made to believe that India has all the global tech talent. And when the AI moment came, it was found that all the talent is in actually China. So these guys are just stuck right now. Metals continue to outperform, and they should perform well now from here because if the dollar is weakening and there is a scarcity expected all over the world. Autos are at all-time high, so it can move up. But the point is that the rising metal prices are negative for autos, so one has to be careful here. Defense bounced from the lows. It was correcting. It has bounced on this DAC thing and all that, but nothing much till the time the budget and earnings are seen. Midcaps underperformed. It had gone up, but it corrected. Uh, Small caps bounced. So this was one index which has bounced from the lows. So that is positive. HDFC Bank is trading along the 20 EMA. So it is around this 980, 985 zone. Faces resistance at 1020. So if this support holds, then it's okay. Same with Reliance, it has broken through this resistance, but it is not able to go up above 1600. Will now require fresh triggers. Now, this was one stock which rallied last week with good volumes. If you see strong volumes in copper. Now, I've shown you copper prices. Not there is not much. The amount of move, 22% move on in copper is not justified. But these are small the rallies which are taking place, which are basically trading rallies. So now this is a very important point about sectors in stocks positioned to be the primary beneficiaries of US India trade deal. Why am I talking about this? Because you can position yourself for the trade deal because some of these stocks will move substantially once this trade deal gets announced. First is IT and software services. They should benefit because it will ease the entry of professionals and potential reduction in indirect costs related to US data and digital taxation rules. So it should help them. Then pharma and healthcare, removal of 100% duties on certain branded patented drugs and streamlined FDA approvals for generic export should help them. Textiles, apparel, and footwear, a 100% tariff cut in this sector is estimated to boost Indian textile exports to the US by nearly 85%. Then defense and strategic technology. So that direct technology transfer and long-term joint venture contracts for manufacturing advanced military hardware should help. Engineering and auto ancillaries. Lower import duties on Indian made tires, forged parts, and industrial machinery should help them. Aquaculture, seafood. Our trade deal would be a life saving catalyst for Indian shrimp exporters who have been reeling under extreme US tariffs totaling nearly 58.26%, comprising 50% reciprocal tariff plus anti dumping and countervailing duties. So, actually, this is where you will get big moves. Gems and jewelry reversal of recent slump in exports caused by high trade barriers, revitalizing the diamond processing hubs in Surat, etc. So these guys will also be this thing. So let's see each sector. First, IT. So the best bellwether is Infosys. Now, if you see Infosys, it is still closer to above all the moving averages, and it has moved a lot. Now, if you see, this is at around 24 P right now, which is slightly higher than its long-term P, but it finds good support at 1400 levels and all that. There is an additional support of that buyback also, which helped them. Uh, Last quarter, they did 5% revenue growth and 6% PAT growth. So nothing great about it. Constant currency growth was just 2.2%. So let's see the earnings. So if you see, they did around, so in rupee terms, if you see 5% revenue growth and 6% PAT growth. So in my opinion, it is adequately priced. You will get a small bounce, but beyond that, nothing much. Next is Sun Pharma. Now, if you see Sun Pharma, the stock has been trading in this range now, uh, 1900 and 1600 around. So this should be a clear winner. Right now, it is at support. So if it comes to around 1600, that should be a good buying opportunity. Now, if you see their earnings, they did around year on year 8.9% growth, and profit was up only 2.6%. They have been impacted by all these tariffs. I'll show you the reason. You see, for them, the formulation is the main business, and API and others are the smaller parts of the businesses. Now, in formulations, roughly 30% of the business is from US, and that has not changed. That has not grown. So they would be really helped by a trade deal. So if you see, 30% is US formulations, and it has come down. So in last 1 year, the US formulation business, which was earlier 33%, has come down because they have grown the rest of the world, that is Western Europe, Canada, Japan, Australia, New Zealand, Israel, and other markets. They have grown that business. So they are also trying to diversify, but the key component of the business for them is US. So that they should be helped. Next is Gokul Das Exports. So if you see here, this stock is basically a garment apparel exporter, and it moves with the trade deal news. So if you see here, last year after Trump uh, inauguration, it moved up, then it came down. Then again in April also, there was some positive news, so it went up on trade deal. Then it came down, took support at around 200 EMA at 680. But if you see the pattern, it is making lower highs and lower lows. Now again, at for the year end in November, it went up on some positive news on trade deal, but that has fizzled out, and now it is moving down. Uh, so in case it will comes to around this 680, 670 level, that should be the level to look at this stock. But it will be totally dependent on the trade deal. Now let's see their earnings. So if you see here, year on year, their income growth is just 7%, while EBITDA margins, because of this trade deal issue, have come down. So year on year, they have come down 41 basis point, and Q and Q, the EBITDA margins have come down by nearly 380 basis points. And PAT has come down 71% uh, year on year and 81% Q and Q. Basically, what, as I had covered with phase 3 also, they are giving discounts in terms of cutting their margins to their clients just to ensure that their clients are not lost. So this is the basic issue. So they should benefit from the trade deal. But even now, Gokuldas exports is at around 37p, so it is expensive. The other stock in the same sector are Pearl Global, Indocount, etc., which are at a lower P. But this is one stock which will reflect uh, the movement in trade deals or will move along with the trade deal news. So if you see here, 7% year-on-year growth, nothing much. EBITDA has just moved 1%, and PBT, profit before tax, was down 47%. So they have been drastically impacted by the earnings have been drastically impacted by the uh, tariffs on their business in the US. But with the enthusiasm, regular enthusiasm, it is not reflected in the stock price. Hence why that's why I said that the valuations are still expensive. Now, if you see here, apparel dominates India's textile exports. So, if you see here, of all our exports, apparel are roughly 43%. And apparel exports, 33% of our exports in FY25 were to US, and then balance to UK, EU, etc. So, US is a sizable market, and apparel exports are getting impacted. Now, coming to defense and technology wise, the biggest impact would be on HAL. Now, if you see here, HAL also has not moved much. It is in this range. It went and made a low of 4,200 odd and then bounced a bit from here, but there's not much of enthusiasm. The reason is if you see their earnings, because these are to be compared year on year, uh, they did just 11% revenue and 11% PAT growth. So they are at 35p at doing around 11% revenue and PAT growth. It's expensive. So this should be a clear winner in case there is a trade deal and the engines they are getting from GE issue gets sorted out. Next is Sona BLW. So if you see here, this stock is also corrected, made a low in April of around 375 and has moved up a bit, but still is subdued. All the moving averages are like 20 EMA is below all the other moving averages, and the stock is just above the 20 EMA. So nothing much here. And it is still expensive. It is still at 48p. Now, coming to their earnings, you see, they did an acquisition of the Escorts railway business. So the revenues were up 24% because of that. But the BEV, that is battery electric vehicles, that is the electric vehicle revenues have declined for them in FY26. Though overall revenue grew 24% during the quarter. And if you see here, the EBITDA margins have also declined for them. Though EBITDA grew 13% only, but EBITDA margins have declined. And PAT margins have also declined for them. Now, if you see their revenue mix, again, if you see here, uh, in FY25, North America used to be 41%. It has come down to 30%. So they are now diversifying basically into India and to other businesses. So if you see, earlier there were PV, CB, and E two-wheelers and E three-wheelers were major part of their businesses. They have reduced that and now moved into non-automotive part more. That is basically railways. So they are also diversifying. So they should be also benefited. Only thing is that it is still expensive with the amount of growth, etc. they are giving. The stock, in my opinion, which will benefit the most with this trade deal should be Apex Frozen Food. Now, this stock moves with the news, and after the earnings, it went up and it has corrected. So, any dip, says to somewhere around 245 to 50 zone should be a good buying opportunity for this stock. I'll tell you why. So, if you see, this has been a turnaround quarter. Last quarter was a turnaround quarter for them. So the income went up 22%. but the EBITDA went up to 84%, right? And margins improved. Profit before tax from loss-making company, they became profitable. One of the reasons was they have retired their debt, so the finance cost came down. So if you see even Q and Q, the profit is up around 30%. And for H1, they have done roughly, if you see, this is in millions, 21 crore. Now, if you see, if H1 they have done 21 crore, basically they are diversifying and doing the good business, better price realization. US sales though have declined by 10%, but they have diversified to Russia, Australia, China, etc., and then have reduced debt. Now the point is, in H1 they have done 21 crore profit. So even if you just do double of that, that means 42 crore for the full year. They are at around 862 crore market cap. So 862 crore market cap with 42 crore profit is roughly 20 times. So they are not very expensive as such. Uh, right now they look expensive on trailing PE, etc. because of last year was basically lost making. Because there was problem with the business, but the businesses have now improved. So consider that. I personally feel it should do well. And Avanti Feeds is at around 18, but Avanti is more related to feeds business and not related to shrimp business. So these guys are should be clear beneficiaries of shrimp business. If you see India seafood exports, driven by basically frozen shrimp and other seafood. So it has come down. Total seafood has come down in FY25 as compared to FY24, etc. But if you see here, export mix still 42% was to US only. And this is again becoming very competitive. So there is these sales which have declined is also because there is a lot of competition due to tariffs from other countries. So this should be one business which should really do well once the tariffs are removed. I finished. We'll take questions now.